right, I'm going to go ahead and get started. Welcome, everyone. Thank you for joining us today for our webinar, Tax Considerations for the Hospitality and Tourism Industry, and what you need to know under the One Big Beautiful Bill Act. My name is Jennifer Sin. I'm the co-chair of the Schoeneck King Hospitality and Tourism Industry Group. Our group represents all kinds of businesses in the hospitality and tourism industry, including wineries, distilleries, breweries, lodging facilities, hotels, restaurants, pretty much any kind of business in the hospitality and tourism industry. And we're, as a group, are focusing on providing you all with information and guidance that we think is going to be valuable to you specifically, because we know that your industry faces different challenges than some other industries. So we wanted to put this webinar together today. I'm sure you've all heard a lot about the One Big Beautiful Bill Act, and we know that tax is a tough issue to confront, but we wanted to highlight some issues that we have found that are tax related that specifically affect you in the hospitality and tourism industry. So that's what we want to focus on today. So joining me today are Frank Mayer and Jessica Blanchett, who work with me in Bond's Albany office. And our first presenter is going to be Frank Mayer. Frank is both an attorney and a CPA, and he is the chair of Bond's Tax Practice Group. Frank's areas of practice include corporate and business law, tax planning for closely held entities, manufacturing and service businesses, estate planning and estate administration with a concentration in tax-related matters. He provides advice on choice of entity decisions, worker classification issues, corporate reorganizations, business succession planning, and a variety of other tax issues. Frank has extensive experience in federal and state payroll tax matters. And today, Frank is going to give us an update on the One Big Beautiful Bill Act and some other tax issues that he knows are important to industry. I know you've heard a lot about this bill, but we wanted to focus on some of these new provisions that we know might have a real impact on you in the hospitality and tourism industry. So, Frank, please go ahead.
Thank you for that introduction, Jennifer. Good afternoon, everyone. It's afternoon because it's 12:03, so we'll call it that. Next slide, please, Kathy. So a quick overview of what we're going to be talking about today. These are some of the topics which I think would be of interest to this particular group under the One Big Beautiful Bill Act signed into law on July 4th of this year. The last topic, employment of telecommuters, I have there as a throwaway. Should we have time to talk about it? That's not something that's under the Big Beautiful Bill Act, but it's something that many employers deal with when it comes to hiring remote employees. So let's get to it. So next slide, please. So for calendar years 25 through 28, individuals receiving qualified overtime comp can deduct a portion of their pay that exceeds the regular pay. This would be the half time of the time and a half required under Section 7 of the Fair Labor Standards Act. So, so as an example, let's say you have a non-exempt employee who gets $16 an hour. They work 1 hour of overtime and they're paid $24. The overtime premium of $8 in this particular case would be the amount that could potentially be deducted by the employee. So the topic heading and the way it's framed in the popular press is a little misleading about there's no tax on overtime. There's no tax on overtime for income tax purposes, subject to the fact that it's only the premium that is deductible. Next slide, Kathy. The deduction applies, as I say, for income tax purposes only, but it doesn't include FICA. So even though you might be able to enjoy, employees might be able to enjoy a deduction for the premium on overtime, they won't get that same benefit with regard to the Social Security and Medicare taxes. Now, qualified overtime compensation, as I mentioned, includes overtime paid under the Fair Labor Standards Act under Section 7. So what's that? So that's really when you work more than 40 hours a week, that time and a half that non-exempts are entitled to under that act. It doesn't include overtime paid as a result of heightened state law, and it doesn't include overtime paid as a result of a negotiated bargain agreement. So for example, if you have a bargain agreement with employees that says you're paid for overtime, anything over 7 hours in a given day, that extra hour worked, for example, would not be considered qualified overtime under the Big Beautiful Bill Act. So the maximum deduction for overtime would be $12,500 for an individual or $25,000 for joint filers. The deduction phases out at $150,000 for individuals and $300 for joint filers. Next slide. So the good news is that this deduction is available for employees who are both itemizing and non-itemizing taxpayers. So for 25, the IRS has said that the service recipients may use, the employers or service recipients may use any reasonable method to determine what qualified overtime is to be defined by the IRS. So there's a lot of guidance out there for 26, but right now we're waiting for more guidance on what to do to account for this overtime in 2025. And hopefully the IRS before the end of the year will give us advice on how to report all of this on Form W-2 or 1099 NEC, because this qualified overtime comp is enacted under the Big Beautiful Bill, retroactive to the 1st of 2025. So for 25, there's no changes to withholding required. And for 26 through 28, the IRS is required to provide updated income tax withholding requirements, which we'll talk about to address any possible deduction by individuals. Next slide, Kathy. Again, the IRS is going to be updating the instructions, and they have released to these two forms W-2 and W-4. They have released some proofs, some drafts. So Form W-4, which I'm sure many of you, most all of you are familiar with, the employee's withholding certificate, has been updated with the addition of a worksheet so that you can compute what your expected qualified overtime might be, and that could affect and possibly reduce your withholding during the course of the year if you just don't want to wait to the end of the year to see if you're eligible to claim the deduction. Form W-2, the wage and tax statement that everyone waits with bated breath to receive, adds a new code, information code TT in box 12 for qualified overtime reporting. Excuse me, taxpayers should use this amount in determining what they deduct on Schedule 1A for purposes of 1040. Next slide. So now that's overtime. Let's talk about qualified tips, because many of the same rules will apply. So for calendar years 25 through 28, individuals receiving qualified tips may deduct the qualified tips, but again, the operative term is qualified tips. The deduction, like the overtime deduction, applies for income tax purposes, but not FICA tax, Social Security, and Medicare. Next slide. So what are qualified tips? Well, qualified tips means cash tips, including credit card tips and fee arrangements, tip sharing and fee arrangements received by an individual in an occupation that customarily and regularly receives tips as determined by the IRS on December 31st, 2024. This amount has to be paid voluntarily without consequences. It's not something that's the subject of any sort of negotiation. So if you go out with a big group and there's an 18% service charge because you have a big family, that is not considered a qualified tip. Only discretionary tips again, customer discretionary tips are the tips that would qualify. Additionally, the IRS has limited the particular businesses to not include what's called certain specified service trades or business. I highly doubt that anyone on this webinar today is a specified trade or business as defined in the code that I cite. That usually typically includes things like accounting, law, actuarial science, finance, and healthcare. And then the catch-all, of course, is any other requirements established by the IRS. Next slide, Kathy. So a separate accounting of any amounts reasonably designated as cash tips, and the occupation of the person receiving these tips must be reported on Form W-2, 1099-K MIS, 1099 MIS, or 1099 NEC as applicable for the to the service provider. The maximum deduction for individuals is $25,000. The deduction, like with respect to qualified overtime, phases out for adjusted gross income, modified adjusted gross income over 150,000 or 300,000 for joint filers. Next slide. Deduction is available like qualified overtime for both itemizing and not itemizing tax credit. And also, while we're on this subject, the FICA tip credit for a portion of the employer paid Social Security taxes for employee cash tips is expanded to certain barbering and beauty service, spa treatment type industries. The IRS has released proposed regulations in September, which are subject to public comment. And it includes a list of occupations that customarily and regularly receive tips on or before December 31st, 2024. Next slide. For 2025, employers or service recipients, again, like with regard to qualified overtime, can use any reasonable method to approximate a separate accounting of amounts designated as cash tips and reported by such individual to be reported on W-2 or 1099 NEC. And again, there are no changes to withholding required. And for 26 through 28, the IRS is again required to provide updated tax withholding information to provide the employees with what they need to prepare their tax returns. Next slide. Thank you. For 26 through 28, forms W-2 and NEC, together with their instructions, again, have been issued in draft form. The W-4, again, like I mentioned, with regard to the qualified overtime, has a section, a schedule on the back where a person can estimate their qualified tips so that an employer can adjust withholding during the course of the year rather than waiting at the end of the year to possibly claim a deduction. The Form W-2, the proof of Form W-2 for 26 includes a new code TP to report in box 12 for the total amount of cash tips reported to the employer where the business is not a specified service trade or business, which is this health, accounting, law, financial services type industries. This should be used in determining the deduction for qualified tips on Schedule 1A of Form 1040. Next slide. So again, a code TS is also added for box 12 for the total amount of cash tips reported to the employer where the employee is a specified service trade or business, these health, law, accounting, and financial service business. So this is something, if you get anything as a TS code, it's not something you would use as for taking a deduction for qualified tips. The IRS has also modified the 26 and forward Form W-2 to add a new box 14, which is the information box, which is used to provide something called the Treasury Tipped Occupation Code. Those are in those regulations, proposed regulations that I mentioned. For example, the tip occupation code for a bartender is a 101, and the tip occupation code for wait staff is 102. If you end up with a 000 in there is used, then the employee's cash tips are not qualified tips and should not be used to deduct the amount reported in box 12 code TP for the deduction for qualified tips. Next slide. So moving on now, we're talking about something which is a little bit more taxpayer friendly from your point of view as business owners and employers. Beginning in January 1st, 26, the reporting threshold for the Form 1099, 1099 MIS, and 1099 NEC increases from $600 to $2,000. So that $600 number that we all know so well and has been there forever is now $2,000. That'll reduce the burden a little bit on reporting these types of payments. Beginning in 27, the 2,000 reporting threshold will be adjusted for inflation. For purposes of Form 1099K, this third-party settlement organization, which is used for such things as reporting eBay transactions or digital wallets and the like, the threshold will be reset at $20,000 and 200 transactions. So it's both 20,000 and 200 transactions, unless you use a third-party provider or for a digital wallet to report payments normally that go on 1099 MIC or 1099 NEC. You would use the lower threshold for that. So if you pay your contractors on a 1099K, but you would normally be a payment that would normally go on a 1099 NEC, you would use the lower threshold. Next slide. Moving along to expenses for moving. The income inclusion for moving expense reimbursements under the Tax Cuts and Jobs Act of 2017, the limitation on that deduction was set to expire in December 31st, 2025. However, that exclusion has now been made permanent unless the employee relocating is a member of the intelligence community or members of the military. So probably not something that employers in this group would be able to avail themselves of and offer as a benefit to employees. Moving expense reimbursements, other than with respect to these narrow exceptions, would be considered plain vanilla wages subject to tax withholding and reporting on Form W-2. Next slide. Moving to state taxes on pass-through entities. So those of you who operate your businesses as S corporations or multi-member LLCs, taxable as a partnership under the Tax Cuts and Jobs Act in 2017. You remember that most states enacted laws to allow state income taxes to be paid at the entity level on behalf of the members or shareholders, the owners of the business. Since the BBB is silent on the pass-through entity taxes, the IRS has notice in place that 2020-75, the pass-through entity taxes still remains a viable opportunity. You may remember that the organization started using this as a workaround to the limit of $10,000 of deductibility of state taxes. So taxes paid at the entity level can be treated as a workaround of that $10,000, that stingy $10,000 limit. Now, let's move to the next slide, please. Moving on to the state and local tax deduction, the SALT deduction, which we're talking about, that $10,000 cap. That cap is increased from $10,000 to $40,000, but only temporarily, or half of that amount for people filing separate returns for 2025. The deduction phases down to not less than 10 to the extent a taxpayer's modified adjusted gross income exceeds 500,000 or half that amount for separate filers. So between January 1st, 25 and December 29, the cap and income thresholds will increase by 1% each year. So next year, the cap will be not 40,000, but 40,400. Thereafter, after 29, the cap will reach set to $10,000. Next slide. So we'll talk about now the extension and increase of the qualified QBI deduction, which is something also that owners of S corporations and multi-member LLCs or partnerships taxed as a partnership enjoy pass-through entities. The law makes the qualified business income deduction at its current level of 20% taxable income. This applies again to certain domestic trades or businesses operating as either an S corp, partnership, trust, sole proprietorship, or estate. The deduction begins to phase out at $394,600 for 2025, adjusted for inflation in 2026 and beyond. Next slide. Now, the taxable income phase out range increases from 100,000 to 150,000 for joint filers and from 50 to 75 for single filers. And the law establishes an inflation-adjusted minimum deduction of $400 for taxpayers with at least $1,000 of qualified income from active trades or businesses. Next slide. Talk a little bit about bonus depreciation for certain business property, going back again to the 2017 Tax Cuts and Jobs Act. This bonus depreciation was reduced by 20% each year beginning in 22, and it would have been phased out completely by 26. It has been reinstated and made permanent. So this applies to certain qualifying property acquired and placed in service after January 19th, 2025. Next slide. Excuse me. So this includes most tangible personal property that's used in a trade or business with a recovery period of 20 years or less. And you'll note on the chart, it includes such things as furniture and equipment, machinery, computers, and certain land improvements. Next slide. Accompanying the bonus depreciation, but not the same thing, is the increase in deduction under Section 179. You've probably heard over the years, you know, we can 179 that and expense certain capital improvements. Well, the good news is for all of you who are business owners that expensing of certain property under 179 is increased to 2.5 million with a phase out beginning at 4 million. And as you'll see, it applies to certain equipment, machinery, software, and other non-residential property improvements such as security systems, HVACs, and roofing. Next slide. So again, I mentioned the phase out begins at 4 million and it phases out completely once the investment reaches 6.5 million. So to take a quick example, taxpayer purchases qualifying property of 5.5 million that exceeds the threshold of 4 million by 1.5 million. So accordingly, the allowed deduction is reduced dollar for dollar from 2.5 million to 1. So the 5.5 less 4 is 1.5 million. 1.5 million is deducted or subtracted from 2.5 million to leave you with an allowable $1 million deduction under Section 179. And this applies to property that's placed in service after December 31st, 2024. And these amounts will be increased for inflation for tax years beginning after 2025. Next slide. Okay, so I've got 6 minutes before they take out the hook. So I'm going to try to run through a little bit of this issue with employment of telecommuters. So many businesses today, due to the difficulty of hiring workers, finding workers locally, will employ certain workers, you know, outside the state, you know, be it accounting or IT people, and usually the working relationship is great. It allows people to expand their talent pool, employers to expand their talent pool, but there are certain responsibilities that employers have to deal with. So if you take nothing away from this section of the presentation, know this, that wages are subject to taxation in the jurisdiction where the services are performed. It doesn't matter where the payment is made. It doesn't matter where the employer is located. It matters where the rendered services are rendered. So if the services are rendered in New York, they're taxable in New York. If they're rendered in Pennsylvania, they're taxable in Pennsylvania. And if they're registered in London, England, then they're taxable there. So as a result, employers typically need to register for income taxes, unemployment insurance, workers' comp, and other lawfully required benefits in the worked-in jurisdiction. And typically the employment laws of the local jurisdiction apply. Now, next slide. Thank you. So employer registration in the state may be considered creating nexus or taxable presence in the state for corporate or business income tax purposes. For pass-through entities, it could require owners of businesses to file personal income tax return in a state where they receive a K-1. And again, like I say, it may require filing of corporate tax returns, certainly will require filing of state payroll tax returns and unemployment tax returns. Next slide. So in-state activities may also require an employer to register to do business in the state. Now, registering as an employer in the state isn't the same thing as registering to do business. Registering to do business is typically done with the Department of State, where registering as an employer is often done with the Department of Labor or state tax department. Now, the failure to register may prevent an entity from bringing a lawsuit in the state, but it may typically allow you to defend in the state. And here comes the unfun part. Most states impose penalties on unregistered foreign corporations or other entities that transact business, and having an employee working remotely in the state in many cases is likely to be considered transacting business, even if they work off their kitchen table. So some states will go as far to impose penalties on officers or directors of non-compliant foreign corporations. Next and last slide for me, please. So New York has a rule that they call the convenience of the employer rule, but I like to refer to it as the inconvenience of the employer rule. And it's something that fetters New York employers. So New York State employers are required to withhold income taxes as well as income taxes in the state where the services are rendered, unless the employee has a bona fide home office in the other state to avoid New York withholding. But that's a pretty heavy bar, a pretty heavy lift. So it becomes a question of what's convenient for the employee versus what's necessary for the employer. And this is based on certain factors enumerated in a publication provided by New York State. It's called TSB-M-065 open paren 5 close paren. It was published in 506. So it's been around for quite a while. And unless the employee working out of state meets a primary factor, which is nearing specialized equipment, which is critical to the employer's business, but not available in New York, then the individual is going to be subject to tax on their income from New York, income in New York, even though they rarely, if ever, set foot in New York. So if you can't meet that primary factor, you get a second bite of the apple if you meet 4 of 6 secondary factors and 3 of 10 ancillary factors, all in that TSBM that I cited. And if anyone wants a copy of it, I'll get it across to you after the presentation. So one thing we want to make sure we do is don't provide tax advice to employees, but you want to suggest employees consult their own tax advisor regarding the availability of a home state credit for New York taxes paid. Some states provide such a credit. Often those credits are limited, though, only to days actually worked in New York, not days worked at your kitchen table from the out-of-state location from New York. So employers that don't withhold New York taxes can face penalties for assessments for taxes and interest, together with personal liability for officers and directors for being what's called a responsible person and making a decision not to withhold New York taxes on out-of-state workers. So out of abundance of caution, the best thing to do is to withhold New York taxes as well as home state taxes when it's appropriate to let employees pursue a refund. Employees can pursue a refund on their own for the New York taxes that the employer has withheld, and it's not a burden on the employer to have to guess what New York State might do and whether New York State would come after an employer for the failure to withhold taxes. And this could trigger liability even if the employee comes into the state, near the end of the year for a day or two, although I question whether New York would really want to take that case to task. They haven't yet, to my knowledge, but again, just because you withhold New York taxes, the employee can file, out-of-state employee can file a New York non-resident return and request those taxes back, and then it becomes the employee's challenge, not you as an employer. So that's my quick overview of the one big beautiful bill as it may apply to the hospitality industry. And I threw in a little bit there on telecommuters. If you have any questions, I'd be happy to reach out to you either by email. Feel free to reach out to me by email or by telephone. I look forward to talking with you. Thank you for your attention today.
Thank you, Frank. That was great. I appreciate that. Great information. I should have said this at the beginning. If you have any questions, feel free to enter them into the text there. We'll answer any that we can while the presentation is going on. Anything we don't get to, we'll certainly get you answers afterwards. Thank you, Frank. That was great. So now
My
we're going to
pleasure.
hear from Jessica Blanchette, who's going to give you some information on navigating the sales tax audit process from initiation to appeal. Jessica is a business attorney who engages in a comprehensive practice comprising corporate and business law, property law, and tax matters. Jessica takes a comprehensive practical approach to the practice of law, and she advises individual, for-profit, non-for-profit clients on navigating a range of complex corporate business, property, and tax laws to meet their objectives and their goals with a focus on mitigating risk. So Jessica, please go ahead.
All right, thanks, Jen. Thank you. Very happy to be here talking to you today. So we are going to talk very briefly and generally about the sales tax audit process in New York State with a focus on the hospitality and tourism industry. Next slide, please. Okay, so to start, let's just review, quickly, what are the sales tax obligations in New York State? So every taxpayer that is required to collect and remit sales tax must first be registered with the Department of Tax and Finance as a sales tax vendor. And so once you're registered as the sales tax vendor, taxpayers will be given by the tax department a certificate of authority, and that allows them to proceed under that status as sales tax vendor to do all of the things that sales tax vendors do. So once you're registered, the state is then going to be looking for taxpayers to collect and remit sales tax. And so that's going to require the taxpayer to properly ascertain the full amount of sales tax due, collect and hold that amount in a separate bank account, and then timely remit that payment when due. Taxpayers also have to timely file quarterly sales tax returns. And some taxpayers prepare these in-house, others will rely on their accountants or other third-party vendors. Just depends on operations and preference. But no matter what, in either case, it is the taxpayer's statutory obligation. So this is written into law to keep adequate records, what's known as adequate records in case of audit. And so these adequate records can include, but certainly not limited to your sales tax returns, federal income tax returns, cash receipt journals, check disbursement journals, purchase invoices, bank statements, general ledger, and the likes of those documents. A lot of this is now electronic too. We do recognize that, but keeping these records, complete, organized, easily accessible is going to make any sales tax audit run much more smoother. Next slide, please. Okay, and again, we're just going to hit the highlights of the audit process in 3 basic steps. So audit can occur for any reason. It can, failure of what we just discussed, failure to properly ascertain the amount of sales tax due, failure to collect and remit, or failure to file returns, or audit can occur for no reason at all. Just depends. But typically first in the process, the auditor is going to reach out to a taxpayer with an introductory letter and an information document request, an IDR. IDRs typically include questions about who are the owners of the taxpayer, who are the decision makers, and who are what we call the responsible persons. And then it's also going to make that certain documentation request. So for those adequate records we talked about, the books, the records, the tax returns. As a note here too, auditors are always going to ask for those responsible persons because sales tax is what's known as a trust fund tax, which means that if an entity taxpayer is liable for unpaid sales tax, that entity taxpayer's responsible persons will be jointly and severally liable, both individually and personally, for that same amount of unpaid sales tax liability. Basically, if the entity taxpayer doesn't pay, the tax department can then recover from the responsible persons personally. So we always like to make a note of that to people just so that they understand exactly how much is, can be at risk with these sales tax audits. So with that in mind, please do not ignore the IDR or the auditor's requests. Unfortunately, they won't go away despite some of our best, wishes. There's typically also a due date in the IDR, and if you miss the due date, then you're kind of starting off the relationship with the auditor on the wrong foot, and nobody really wants that. So do be responsive to the auditor when they do contact you. And then also, I think it's imperative to kind of give your accountant, your attorney, or any third party that you trust, a trusted advisor, a copy of the IDR and a heads up, and have them assist you through this process. So because what you put on an IDR is technically, voluntary information, you're going to be bound by it through both the audit process and then even through appeal. I have seen that happen. So it's just important to, include your advisors from the very beginning and then, answer those questions accurately and succinctly. Next slide, please. Okay, so second step, right? We get our IDR, we give all of the documents to the auditor. Then the auditor is going to conduct his or her review of what we give them. And they're going to kind of sort things into what we call three buckets: sales, expenses, capital items. So sales, this is the big one. This is where we see the most contention. The auditor is basically going to be looking for deficiencies across the board and sales tax across the board. So two primary things we usually run into more often than not is deficiencies in a taxpayer's ascertainment of sales tax due. So how much is due? So for example, we had a client whose end product was an electronic report, and the auditor and our client disagreed on what the point of delivery was for that electronic report to determine whether sales tax was due in the state of New York or if it was due to another state or what have you. It was the only point of contention, and I actually don't think we ever reached an agreement, but did end up settling. So that's just one example of, point of contention. And then the second one is that we see often is in tax exempt records. So for another example, we had a client who worked for both not-for-profit entities and government agencies. And while both are generally tax, exempt from sales tax, there are very different record keeping requirements for each. And so we helped that client kind of distinguish between the two so that they could, keep complete and accurate records, both through audit and then afterwards, in preparation of potentially another audit. So second, the auditor is going to look at expenses. They're going to look at recurring expenses just to confirm that the taxpayer paid tax on all of its materials, supplies, services, basically anything not on a depreciation schedule. And then third, capital items. So they're going to look at the taxpayer's purchase of capital items or fixed assets. So an example of this, we had actually a hotel client who was under audit. They had undertaken a large-scale renovation of their hotel, and the auditor took the position that many of the items were not technically capital improvements, and therefore they were all taxable. So we obviously argued and presented evidence to the contrary, but sometimes, just an example, these rules get so granular that the taxability of one of the services came down to whether the painting service was performed on an existing wall, which is taxable, versus on a newly constructed wall, which is not taxable. And so sometimes the analysis really does just get that detailed. And again, this is just demonstrating the importance of that adequate record keeping. So then, the taxpayer, after all of these things are reviewed, the auditor is going to kind of make their work papers, their findings. The auditor and the taxpayer can have a back and forth conversation. It's not just the auditor saying, here's my findings, and that's it. There's usually some kind of conversation that goes on until the parties either agree on amount of sales tax due or just agree to disagree, and then proceed forward. Next slide. And then finally, the auditor is going to issue a notice of determination. And so this notice of determination is the conclusion of the audit. Basically, it's going to outline the total amount of sales tax, interest, and penalties, if any, that the auditor has determined is due. This is the big one because this is the notice that's also going to trigger your appeal rights. So you want to make sure that you definitely get this from the auditor. We don't lose sight of it. That is your gateway to an appeal if you need one. Next slide. And then once we're in appeals, should you choose to go to appeal, once again, that notice of determination is issued, you can appeal to either the Bureau of Conciliation and Mediation Services, the BCMS, for what's called a conciliation conference, or to the Division of Tax Appeals for a more formal hearing. So in either event, though, you do have to file the request for either the conciliation conference or the appeal within the timeframe specified in the notice of determination. It's typically 90 days, but it can vary. And so we always tell taxpayers, get that notice of determination, let's look at it immediately and decide the best way forward. Also, just a note, there are no exceptions to missing the deadline. So if you do miss that deadline, the amounts in that notice of determination do become, fixed, final, due, and payable, which means that assessment just goes straight to collections department and they will proceed accordingly. So assuming that we do file, let's say we go to a conciliation conference, this is kind of a more informal mediation type proceeding. The taxpayer is represented usually by the auditor and a supervisor. They present their case first, then the taxpayer and their representatives will present their case second. And the conferee just kind of facilitates discussion between the two, right? Like we're still trying to reach some kind of mutual agreement as to a resolution. At the end of the conference, the conferee will issue a consent that's either going to modify or sustain the amounts due based on the parties' negotiation. So if you agree, great, we sign it. If you disagree, you can always file a petition then with the Division of Tax Appeals. And this one's usually within 30 days of the conference, the conferee's concluding document. So a hearing at the Division of Tax Appeals is more of an adversarial proceeding where the parties are going to draft more formal papers, briefs. They're going to submit evidence for consideration. It's more of a formal hearing process. And then after the hearing, the administrative law judge, the ALJ, is going to render a determination that they feel is most appropriate for the situation. And there are additional levels of appeal. We kind of rarely get that far, though. A lot of times the cost to continue appealing is going to exceed the amount of potential recovery, which is just a taxpayer decision, right? They can decide what they want to do, if they want to proceed or not. But typically we do try to reach a resolution more at these stages, at either the audit stage, if not conciliation conference, or at a Division of Tax Appeals hearing. Next slide. So a couple of key takeaways. Again, just keep those adequate records. If you haven't checked your records or your systems in a while, or you have questions about what adequate records might be, it's always a good time to revisit. If and when you do get a notice from an auditor, please do not ignore it. Immediately contact your accountant, attorney, trusted advisor for assistance in responding. And then be as cooperative as possible with the auditor. Again, even though appeals are possible, it's always more cost and time effective to just try and reach a negotiated resolution as early as possible in these processes. Okay, all set.
All right. Thank you, Jessica. I appreciate that. That was great. I know that comes up a lot for our hospitality clients, and I know you've worked through that with some of my clients.
Yes.
When this comes up. So thank you very much for going through that. So I'm just going time. I want to be respectful of everybody's time. So I'm just going to do my portion. I'll just run through that a little bit quickly. As I said at the beginning, I'm Jennifer Sin, also a business law attorney here in our Albany office with Jessica and Frank. I try to act as a general legal advisor to businesses of all sizes, all different kinds. I've got clients from sole proprietors all the way up to big companies with hundreds of employees. And, as co-chair of the hospitality and tourism industry group, I work with clients of all segments of the hospitality industry, hotels, restaurants, bars, nonprofit entities, alcohol manufacturers. I do a lot of liquor licensing work. So I work a lot with clients on their larger business issues, but also those alcohol specific issues, getting licenses. I do retail and manufacturing both. So today, on the tax front, I wanted to just pass along some information about alcohol excise tax. Those of you who are in that space are very familiar with the excise tax rules. I'm not going to get too in the weeds with any of this. But I do want to talk just a little bit about some common mistakes I've seen, give you a couple quick TTB updates. When alcohol excise tax comes up, it's usually because there's a problem, right? Most of you in that space are handling your reporting and your returns yourself. Might be working with an accountant who has a specialty in that. I have some relationships with accountants who have a big focus on that. But when it usually comes to us, it's usually because there's an issue, right? So that is some things I wanted to pass along, some common mistakes and a couple of updates. So Kathy, if you could go to the next slide for me. Thank you. So just quick overview, as I just said, going to give a couple of TTB updates, some common mistakes, and I'm going to talk about a few things specific to CITER because that has come up and that is a little bit of a hot topic with a bill that may or may not come to pass. Next slide, please. All right, so just a couple quick TTB updates. TTB, obviously, Alcohol and Tobacco Tax and Trade Bureau. Those of you in the space, federal agency. It's right now. It's suspended all non-accepted operations, which, when you read their shutdown plan, is most operations. As of right now, you can make and view applications, but nothing's being reviewed, nothing's being processed. Out of curiosity, I looked and it looks like they furloughed almost 400 of the 450 so employees. But not surprising to anybody on this call, you must continue to file your electronic payments and your returns for federal excise taxes and for operational reports. That is still required. Next slide, please. Before the shutdown, the TTB had launched a tax simplification effort, which I was keeping an eye on. They had announced that they were designing some new forms to combine the excise tax return and the specific operational report. Those forms, had not yet been adopted. They were going to start with beer. There was a link where you could request to participate in a pilot program for beer. As of right now, fortunately, that should all be on hold, but we'll be monitoring that to see if that does come to pass. And also, again, before the shutdown, they had put out some updates that they were going to be issuing no more paper checks after September 30th. I'm sure most of you who do have to file these are doing electronic payments anyway, but just wanted to point that out. Next slide, please. All right, so some common mistakes. Alcohol excise tax. When I first started learning about this, realized there's four key takeaways, 4 ways things can go wrong. The alcohol excise tax, it attaches when the product is produced, but it is determined when it is removed from the bonded premises for consumption or sale. Then you've got the third step was when it's paid, and it's paid at that later date. And the fourth sort of key aspect of alcohol excise tax is the tax rate. And that can change a lot. That's based on alcohol content, materials used, production method. So lots of ways things can go wrong in that aspect. Different types of alcohol, beer, your wine, distilled spirits, and subcategories thereof all have different rates. And the rates can vary by volume, alcohol content, method of production scale. So definitely an issue and something to be very careful about. So I'm going to, hit a few highlights of things that we've seen as can be problems. And just note there that applying an incorrect tax rate can lead to audits, penalties can lead to all kinds of issues. So next slide, please. All right, so miscategorization, categorization, something I've seen a lot. So what is a wine? What is a beer? What is a distilled spirit? I'll run through them a little bit. I won't get too, I said before, I won't get too into the weeds. But the takeaway from all of these is if we're not sure, certainly reach out. We'd be happy to go through it. We'd be happy to pull out the statutes, which are quite lengthy, and the regulations, and help you work through what category something might fall in if you're not sure. So wine, the federal, we've got the different categories of still wine, depending on ABV. We've got mead as its own subcategory, which is solely from honey and water. Artificially carbonated wine versus sparkling wine. Next slide, please. Hard cider, and we'll talk a little bit more about that very quickly at the end. But at the TTB level, hard cider, with its hard cider rate, has an ABV of 0.5 to 8.5, and it's taxed as a wine, but it can qualify for a reduced rate for hard cider if you meet certain specifications, which I'll touch on at the end, because hard cider is one that issues can come up. In New York, that hard cider level is 3.2 to 8.5 ABV. And if it contains more than 8.5% ABV in New York, then it's taxed as a wine. Next slide, please. So beer. What is a beer? At the TTB and the New York level for excise tax purposes, it's any fermented beverage brewed or produced wholly from malt, produced from malt wholly or in part, or from substitutes for malt, and it has at least 0.5% ABV. So beer, ale, porter, stout, malt liquor. We'll talk a little bit about that. These malt products, sake and similar products. Sometimes it comes up, questions come up, what is a substitute for malt? The TTB definition includes rice, grain of any kind, bran, glucose, sugar, and molasses. So sometimes you've seen, and I've seen articles about it, and it's come up. What about gluten-free beer? How is that made? What does that fall into? How about adjunct lagers? Questions come up with experimental or craft beers. Does it fall into this or does it not? How is it produced? Next slide, please. Malt beverages, they are made from the alcoholic fermentation of an infusion or decoction or both in potable brewing water of malted barley and hops. So malt beverage is kind of an odd category. A beer made without both malted barley and hops is a beer under the Internal Revenue Code. That's not a malt beverage. Lots of things can fall into malt beverages that you wouldn't necessarily think. It can include hard soda, hard sparkling seltzer, hard lemonade. Malt beverages, actually, ironic, I was reading a case this morning that looks like it's going to be certified as a class action about some manufacturers who are making malt beverages, but there was confusion in the labeling and perhaps confusion in the marketplace where they looked and had flavors similar to certain distilled spirits. And were they really a malt beverage? What were they, and what were they labeled as, and what were they taxed as? Can come up. So malt beverages are one that can be a little tricky. Next slide, please. Beer. So New York State excise tax purposes, lager, ale, porter, stout, braggot. New York specifically mentions, and the New York excise tax for beer is all other fermented beverages from malt and its substitute that are greater than 0.5%. Next slide, please. So liquor, distilled spirits, another one, the TTB definition of distilled spirits is a definition that I've always thought particularly unhelpful because it's defined as all products of distillation which contain distilled spirits. Includes things like whiskey, vodka, rum, gin, brandy, wine, if it's over 24% ABV, falls into a distilled spirit at the federal level for excise tax purposes. And again, that can be different, right, than what sort of TTB permit you need. But for excise tax purposes, if it's over 24%. In New York, it's all distilled or rectified spirits, brandy, cordials, wine or liquor base, whiskey, rum, gin, and all other distilled beverages, and wine containing more than 25% ABV. So as I mentioned, wines over 24%, Texas liquor. Question count, fortified wines, port or sherry. Where is that falling on the ABV scale? Cordials and liquors, what's the ABV? And how's it produced, right? Is it distilled? Could be a specialty wine. It could be a flavored malt beverage. It could be distilled spirit. So we have to get a little bit into the weeds with some of those products to see how they should be categorized for excise tax purposes. Next slide, please. So a couple commonly misclassified products. Canned cocktails and hard seltzers are the ones that seem to come up the most. I get these questions not just on the excise tax side, but even on the licensing side. I'll get calls from some of my manufacturing clients. We're thinking about doing this new product. Does the licenses I have at the TTB level and the New York level, does it cover it? I even get sometimes from retail. Can I sell this under the kind of license I have? And we'll have to get a little specific. For the canned cocktails and the hard seltzer. What does it contain, right? So the canned cocktails, it could be a spirit, it could be a beer, it could be a wine. The hard seltzers, is it made with fermented sugar, have a malt base? Could be a beer, it could be a malt beverage, or some could be a spirit. And we've seen with some of these hard seltzers, you can only buy in a liquor store, right? You can't get them at your grocery store, and that's because how are they made, what's in them, and what's how much alcohol, right? What's the ABV? And also come up with the low alcohol wines, right? Or the fortified wines. So things that we've seen commonly classified. I've seen TTB guidance, some articles written about these as well, but those are the ones to definitely keep an eye on. If that is something you're making, a lot of alcohol manufacturers want to make new products, right? Want to be creative, have new things, have new products, great ideas. It's just be cautious to what category it's really going to fall into. Next slide, please. Touched already a little bit about the flavored malt beverages. How's it made? What's in it? It could be beer or spirit. And hybrid beverages. I've seen what about wine-based spritzers, but we're adding spirits to them. Where's that going to fall? Next slide, please. So documentation, it's been kind of a theme on several of our presentations today. What should be in your logs, right? So certainly not going to list everything or make you all go through 27 CFR chapter 1 subchapter A, but be familiar with those. TTB has actually put out some nice guidance as well, which you might find. I'd be happy to send one about what should be in your documentation, right? So certainly recording operations as they occur, that's important. Getting and retaining your source documents, alcohol content and quantities, obviously very important to have that in your records. Keep in mind, all records are subject to inspection by TTB. It's in the statute you have to keep them, and they do have a right to inspect those. Certainly should be keeping records on your tax class, be keeping them in liters or gallons. TTB specifically requires that you retain those for at least 3 years. New York doesn't have a real clear time limit, but it does require those records be kept at the license premise. Next slide, please. Won't get into these. I want to be respectful of everybody's time. I know we're almost out of time, but if you're looking for the small producer exemption, and I've got some information there, be very cautious about those. Make sure you're keeping records and make sure you're claiming it only on the right things and that you're falling within those levels. Next slide, please. And there is also that New York refundable credit for registered alcohol distributors if you're producing in New York State. I've got the limits there. Happy to send these around, but be cautious about that. Next slide, please. Tax-free shipments, damage return products, again, make sure you've got the good records. Next slide, please. And I'll just touch on this really briefly. Cider, we'll be sending around these slides. Be very cautious about hard cider. There is a lot of issues going on with that right now because the TTB's reduced rate for the hard cider requires that the product be produced primarily from apples and pears or apple and pear juice or concentrate, containing no other fruit product or fruit flavoring, and there's the carbon dioxide limit, right? So this is caused a lot of problems for our cider producers who want to have different fruit flavors, want to have different carbonation levels. Next slide, please. Give a quick update. There are some bills out there. The Bubble Tax Modernization Act, there was a bill in 2024, there's a bill in 2025, and it would modernize the taxation of those carbonated beverages to address the disparity faced by fruit-based cider, mead, and wines compared to the grape-based products. So we'll see if that goes anywhere. That's just something monitoring as things change. Of course, we're going to put out updates to all of you. So thank you. That's the end for me. We're approaching 1 o'clock. We'll keep an eye for any questions anybody had. We'll be happy to answer those after. We will send around the slides we used today. Hopefully that has some information, and those slides will have all of our direct contact information. So please feel free to reach out to any of the 3 of us at any time. Be happy to answer questions or help in any way. And thank you for joining us today. And we hope we'll see you on our next webinar, which should be in early 2026. Thank you, everyone.